Good afternoon, everybody. Welcome to Trader Merlin Show. It is your Monday afternoon. Another short week for the Trader Merlin Show. I know we will not be doing a show Thursday, Friday, or Monday, Tuesday, Wednesday. I'm going to be gone in Northern California enjoying some seasons, getting away from the 75-degree Southern California temperatures. It's the dead of winter. It's 75 degrees. I really can't complain. And then we go to Northern California where I have to I think I actually have to go buy what these things are called, jackets designed to keep you warm. I really don't know what that's like down here in SoCal, but I'll be gone for a few days. Yes, I'm busting out the Run DMC shirt as well today. But that's not the discussion. That's not the topic du jour. I'm sure that Run DMC would not be able to help you with your long-term investments or your portfolios, but maybe your wrap game could increase a little bit with their skills. It is the 18th of December, tail end of the week. We've got a short week next week, another short week, and then all of a sudden our year is over. Holiday season approaching, markets are low liquidity, low volume, and you didn't see a lot of big market movers out there today. So let's go and look at what is important. We had, last week, FOMC announcements and multiple actually, was it last week? It was, time flies. It was last week. And then on Thursday, you had 3 central banks from around the world also making rate announcements. So I thought no better time than to kind of wrap up the year talking about the bond markets with one of my only good bond people I've ever met. Mr. Bill Addiss joining us. You're the only good bond person I've met. I've met other people, I'll tell you what, but I feel like there's always some agenda there. So we've got Bill Addiss joining us today. Bill, how you doing, my friend?
Merlin, thank you. That's a hell of an introduction. Thank you. Good to be with you and the group out there. Thank you.
That's it. Yeah, let's do it. Let's talk bonds. So before I dive into the topic du jour, and here's the graphic for everybody that's interested. It just says how to beat money market funds. And I think what's interesting about this one is we'll talk about what money market funds are, why they're important to you, why they're relevant, and then a very interesting strategy that Bill was going to present to you about how to beat those money market funds, which most of you are probably in right now and you don't even know it. But I'm not going to start there. I want to go into your thoughts on what Jerome Powell said last week, because I dug deep. I actually printed it out. I have the whole printout of his speech, and one of my favorite lines in here, I gotta look at it real quick because I didn't highlight everything. He says, if the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% by the end of 2024. And I thought, okay, well, that's their projection. That's what they're thinking. And I thought, let me look at the actual numbers about what traders who are putting their money where their mouth is, what do they think? Right. And here's the chart. I didn't look at this morning, so it's being updated as we speak. Right now, traders are expecting 3.75 to 4%. So that's over half a point lower than what the Fed is focusing on by the end of next year. And that right now is about a 36.8% chance. So a long-winded discussion to set the stage. But what's your thoughts on what's going on with the Fed and their forecast for rates?
Great question. And there's absolutely no question that, although the Fed did nothing this month, there was actually a change in strategy and a change in direction. They've taken on a much more dovish tone. And, they've acknowledged, as you just indicated, the rates are going to go down. So right. There was a turnaround this week. I also have to point out, though, and I sound like a one-trick pony, I do feel I have to remind everyone that at this point, we still haven't hit the Fed targets on inflation. Mm-hmm. Now, that's not to say that as these pauses have happened and the economy has had a time to catch up, if you will, to the real dramatic actions of the Fed, that we aren't necessarily destined to go there. But we're not there yet. And the marketplace is enjoying a degree of optimism. I've always accused the equity markets of being overly optimistic. They see optimism when I don't, or when bond people don't. Mm-hmm. But I have to admit, even the bond people are showing a degree of optimism that just, in this man's opinion, just doesn't seem warranted. Yes, is a cut in rates imminent for next year? I suppose so. Are we looking, though, at 150 basis points? I mean, that would be as dramatic a cut as they had rise. Right. All at the same time where, inflation, like it or not, is apparently proving to be a little stickier. We have to admit that. But, we haven't hit the goals yet. So I firmly believe that the market has overreacted. We had a jubilant, oh my God, the Fed is done raising. And within a nanosecond, it became, oh my God, the Fed's going to cut by over 1.5%. Yeah. That's a schizophrenia that kind of borders on bipolar, in my opinion.
No, say the markets are bipolar. What are you? Oh, you're crazy.
No exaggeration of volatility these days, is there?
No, none at all.
None at all. But I think the 10-year under 4% is mispriced at this time. If the prices are just too high, the yields are too low. So, if people are looking to lock in yield, and if you think the Fed is done and they're going to be cutting, maybe you do want to start locking in some of these yields, and that's the discussion we should have. But I wouldn't be in a rush. I wouldn't join the pandemonium that's going on. And I would point out, both in equities and in bonds, the actual amount of activity this week is pretty light. It's not taking a lot to move the market this week.
Right. You brought up something interesting, and this has been one piece that's really kind of perplexed me. Yes, we have seen the CPI, the PPI, and the core PCE price index all drop significantly. And of course, everyone's going, yes, our actions are working. But when you look, pull back the curtain a little bit and say, okay, well, you're showing us an end number of all of these different data points. When we look at those numbers, it's jaw-dropping to me that this hasn't been much more talked about. We talk about it here a lot, which is everything else in the market is still going up. Food, all this stuff is going up. But energy, you're down 28% on crude oil since the end of October. So, of course, to me, you have this outlier sell-off in one of the most heavily weighted components of inflation, which is energy. Yep. And to me, that's a one-off. I'll bring up the charts here for the viewers at home. We've looked at this quite a bit. Here's your crude oil chart. Well, this is what has made inflation drop so significantly. It's been that sell-off from September. And I myself think we're actually due for a bounce in crude oil. We're coming right back down to some demand zones we achieved back in March, April, May, June, July. And if we get energy to pop, and food still is not dropping, services numbers aren't dropping, and that keeps going, I can't help but to think that we're going to find ourselves in a situation where the Fed's like, yes, we are seeing increased inflation, and we may actually have to raise here if it does get out of hand. And I know that's a almost worst case scenario, but that's my thought.
But I'm with you on that. I'm with you on that. And again, this is why we had this conversation 2 months ago. We're starting to see a real schism between the CPI and the PCE, the two inflation metrics. And remember the CPI, the main benchmark we've used for years is a survey.
Right.
People are surveyed as to what they think. It's the consumer that is surveyed. And I continue to rattle the cage about, and I had a funny incident this week, the whole topic of skimflation.
Yeah.
We don't realize prices are going up because the packaging is going down.
Shrinkflation. Shrinkflation, as I call it.
Shrinkflation, if you refer to it, or skimflation, they call it.
Yep.
We'll get shot glasses of Coca-Cola at the store soon instead of a 12-ounce can. So the consumer, I don't think is quite realizing, except for maybe food prices. I don't think the consumer is realizing just, how much prices are in fact going up. Now, the PCE is a better adjustment. So that's one of the reasons why the Fed actually looks at that, for just the reasons you're talking about, where we kind of get duped by the surveys.
Yeah, I'll bring up two things for the viewers at home. So give me just a second while I bring this one up. I'll bring up that latest Bureau of Labor Statistics report on the PCE price index, PPI numbers. And, you look at, here it is. And I showed this one to you guys last week. But if you look across the board, it goes down here to November of 2023. Look at energy. November dropped 1.2%. October dropped 6.7%. It was up in September and August, but the biggest declines you see on here have been energy, and everything else is actually consistently staying to the high side. There's some trade numbers that stay there, but food isn't really dropping. Food is up, increased 0.6%, just as it did back in September. So I question the numbers, Bill. It's like, yes, we want to have this soft landing. Yes, we want the economy to smoothly land here, that soft landing everyone talk about, and then we can get back to days of economic prosperity. But I feel like we're almost being misled by the powers that be, because they want us to feel warm and fuzzy. And I'm looking at that energy drop, and I go, what comes down is going to go back up.
And I would point out, energy affects almost every other category. Talk about consumer durables. They have to be shipped. They have to be transported. Right. Food costs and energy costs, the correlation's there. Energy is not just oil and gas. Right. Energy and transportation affects every other single category. Mm-hmm. So, no, I'm worried inflation is stickier. I'm ever the pessimist, but the Fed has said they're going to be data determined. I will keep saying that. If that's true, we have to see if they are in fact have in fact tackled inflation. I'm not so sure.
I'm in that camp of not so sure either, and I'm bringing up the two charts here just because I'm sure people want to know. That blue line, I'll get rid of the upper blue line because that was Goldman Sachs' forecast for oil, which is not going to happen. That blue line there represents that 28% drop, but as Bill mentioned, there's other factors to the energy calculation. One in particular would be natural gas, and your natural gas futures, those are down 38% in that same window of time. So yeah, this is having a profound impact. And, Bill says we're not quite there. We haven't come to the inflation target that the Fed has set of 2%. Well, what's it going to take? We're going to see oil drop another 30%? No. We need to see food prices start to come back down. Of course, they take those elements out. We take out food and energy, which who does that? No one here is living without food or energy.
I love that. Let's pretend we don't eat or use oil. Let's compute it X food and energy. We don't like what that says, so let's ignore it. It's like M1.
Yeah.
Let's ignore it.
Yeah. So the Fed numbers, they said 4.6 by the end of the year. Traders are thinking, 4% or less, which I think is a pretty, 60 basis point differential between those two is pretty interesting. But the Fed made it very clear in the statement. The wording was, we're done for now. He didn't say that, but he was insinuating that we're done for now. The only real scenario that would cause us to raise rates is if we see inflation or some of this data get out of hand. And to me, that's the one wild card is what we just brought up there. Everything else I think is probably looking fine.
And they've caveated that. Exactly. I do have to point one thing out, Merlin. If you notice me smiling on camera, as you were saying, you downloaded it and you were reading me Powell's comments. I distinctly remember maybe 5 or 6 years ago, pre-pandemic, you and I had a program where you were talking about these darn bond people. They microanalyze every adjective, every adverb, and here you are downloading the speeches and contrasting them. Welcome to the club, my friend.
Bill, my therapist knows your name. I'm like, is this Bill Addiss guy? I'm now reading these freaking reports from the Fed announcements, and I know Jerome Powell's child's first name. This is your fault, Bill. It's all your fault.
You're welcome to the club, my friend.
Yeah, no, it's interesting. It's not that I want to hang on every word, but we're trying to figure out what's going to be happening here. Obviously, trends and what the Fed does is going to impact these markets. And if I can stay just a nanosecond in front of that, or perceive information slightly differently and capitalize on that, then that's my job. And I think I mentioned this at a workshop I did for Online Trading Academy on Thursday. I think going forward, the big wild card for our markets is going to be energy. So keep your eye on energy because it has been such a huge factor in the drawdown in inflationary data. If it does surge, we'll be right back to where we were. And they'll be like, we may see rates continue on up. And that would be pretty dramatic for our markets. And right now, we are breathing the sigh of relief, the joy. Here's your S&P again up another 0.5 percentage point today. We're ever so close to all-time highs on the S&P. And, I think most of us would agree it's probably going to hit there by the end of the year just as this current trend continues on up. It's insane.
No, it's amazing. The amount of yield change shortly. Ed Yardeni, an economist who I know quite well, I actually used to be Ed's broker years ago. Ed invented that word, bond vigilantes, and he gets a lot of press for that. The market participants who drive rates up, kind of aberrationally, just with a momentum that is unparalleled. We have to come up with another word because it's kind of the opposite of that, what's going on now. This euphoria driving yields down, the opposite of how the vigilantes are always trying to drive the yields up. So we got a war going on.
Yeah, I brought up one thing that it was derived from one of our conversations in the past. We talk about the supply and demand mechanics that are driving the longer term dated bonds, the 10, 20, 30. Obviously, the short end being manipulated by the Fed. Not controlled. Manipulated is the right word.
Good word.
And my argument about 6 months ago was, I think that the 10-year is going to continue on up. Number one, you have the Treasury Department issuing more and more and more just to cover our interest on our debt. Number two, you have the Federal Reserve, who is one of the largest bondholders in the world, now liquidating their portfolio. They've liquidated $1 trillion worth so far, which is insane. And people not necessarily buying U.S. bonds. You see movement away from the dollar in some countries. So that was my argument for it moving back to the upside, for yields moving up. Now, all of a sudden, we saw this sharp drop, and people have asked me why. And my hypothesis is this, let me know if you think I'm correct or not, is with the announcements by the Fed, which have been, we're pausing. Hey, we may even lower rates here as needed. The global community players who have capital on the sidelines looking for a place to park that money are going, no, not yet. Don't buy the 10 years. We're going to get better yield in 3 months. We'll get better yield in a few months. And then all of a sudden they go, oh, crap. We have to lock in at 4.5% or 4% because if the Fed drops, that long into the yield curve should continue to decline. Would that be one of the factors to its decline?
Absolutely. Absolutely. But I also go back to this euphoria, if you will, because I do want to, I hate to make everything a history lesson, but understand the degree of transparency the Fed is giving us now is unparalleled.
Right.
We get these dot points and we get plots and we get how every voting member is forecasting going out for the next 3 years. I mean, talk about transparency. We're being overwhelmed. And the news media loves it, obviously, but it lets us focus on things that are maybe kind of irrelevant. I mean, the Fed funds rate in 2026, should that necessarily be a poor source of conversation? It was on Bloomberg this morning.
Right.
So this increased transparency, which I think is an effort to kind of fill the 24-hour news machine, is making us aware of things. I go back to the Volcker days, which I contrast because that's when I came into the market. In those days, the Fed didn't tell us anything.
Right.
Literally.
Yeah.
We had to figure out what they were doing. I'm not so sure this increased transparency is necessarily a good thing. I'm not looking for a dark hole, but there's a level of minutia that you can kind of take an argument either way.
Yeah. Yeah, it is, and I grew up a little bit with the Greenspan effect and seeing his impact on the markets, and I kind of like the vagueness of it and the briefcase cam, and you're all excited to see what, those things were kind of fun. It's a new era, it's a new dawn. I like the transparency on one hand, but on the other side, it's like just let the market do its thing,
That's kind of my attitude. Exactly.
Yeah.
Thank you. Yep.
And as a trader, it's the charts. It's ultimately the charts that are going to tell you what's going on. So.
Exactly.
Let's go to, and I got a lot of questions coming through here, so don't worry. We'll get to those questions. I want to make sure I get to all the content. Sure. So here's our graphic for today. It's called How to Beat Money Market Funds. And, I'll put that graphic up for you. Many of you are looking at ways to increase your rate of return over the crappy 0.01% that Chase is going to pay you for your savings account. Do you buy a CD? Do you buy, do you buy bonds? What sort of thing can you be doing? A lot of people have money that's sitting there that literally gets swept into what's called a money market fund. So let's talk a little bit, Bill, first about money market funds, their role, and then we'll dive into the rates of return on them and how you beat those. But tell me about money market funds and how they function.
Great. Thanks for the intro. And the yield curve is really what's driving this discussion. We've got now, as you know, an inverted yield curve where short-term rates are at their highest. And that really represents an opportunity for you if you're looking for yield and liquidity. Now, for most of us, when we want a liquid investment, we are invested. I'll bet you everybody in your audience is invested in a money market fund, right? This is the mutual fund that sweeps your cash on usually a daily basis to get you earning some rate of interest. And the portfolio manager, whether it's Fidelity, Schwab, BlackRock, it doesn't matter. They're all honestly almost exactly the same.
Right.
But they are investing in the shortest maturities possible because they need to give you liquidity. You have to have access to your money. Many people erroneously think money market funds are insured at $1. They're not. There is some risk here. So the way the portfolio managers manage that is to invest in very short maturity bonds. So during the pandemic, short maturity yields were zero.
Right.
So nobody was out there doing anything aggressive with money market funds, nor should they. But if we look, what's happened in the last 3 years is kind of interesting because, as we just talked about, the Fed has been so aggressive in raising short-term rates that these money market funds have become rather attractive yielding. But, and I make this as a big but, during the pandemic, all of the money market funds cut their fees to zero on their funds. Because the interest rate was so low, if they added a fee on top of that, they would have had to charge. They'd have to charge you.
Right, swallow a negative rate. That's no fun.
Exactly, swallow a negative rate and see how you like that. Exactly. So they did a moratorium on the fees. Well, as the Fed's been raising the rates, they've been jacking up the fees big time. I mean, they're now double and triple what they were before the pandemic. I mean, I was using Fidelity funds just as an example. And their fees went from 16 basis points before the pandemic to 42 basis points now.
Wow. So
you're in a money market fund, and you might not be aware that your money manager is taking half a point in some cases for themselves.
Before you go any further, let me ask you real quick.
Go ahead.
With that, I think it's interesting. So I talk a lot about food prices on here because I am a regular at the Habit. I usually go on Fridays with Larry. And when the pandemic hit, it was like $8.36 for a number one combo. Now it's like $12.95. And every single time I go there, they add up a few more cents. And to make a parallel to what you're talking about right now, it's like, okay, I know that most likely those prices are not going to drop. That burger is going to stay at that price, unless all of a sudden their store is empty, then maybe they'll drop a little bit to bring customers in. I look at this point you made here with money market funds, and historically 0.14, 0.16, that's great. Could this be the new normal where fund managers are getting half of 50 basis points on these money market funds just because you didn't know before, you don't know now? Absolutely. Who's going to say differently?
Absolutely.
Yeah.
I mean, this is a hidden tax as far as I'm concerned, because how many of us really pay any attention to our money market funds? It's there. We know it's sweeping in. What they're investing in is probably something that really people don't care about. As long as I have safety, as long as I get my money. But here behind the scenes, these fund managers, and I work for some of them, I think what they're doing in the fee schedule is just reprehensible. And as long as you, the investors, keep accepting it, they'll charge you. You can't put the toothpaste back in the tube. Unless rates go down again, which I'm no way calling for that. Unless rates go down to pandemic type levels where they have to cut the fees again for that reason. No, I think these fees are here to stay. But I really think there's ways with a little bit of time that you can avoid these fees and actually do better than the money market funds are offering. And this was kind of the strategy I was working with. We do this focus class, and I was preparing for our one-day focus class coming up, and I was looking at kind of different strategies, and I kind of came up with something that, you allowed me to spend some time here talking about, where I think I can provide almost like an actionable strategy.
Let's do it.
Normally I'm here. Normally I'm here with macroeconomics, but there's actually something that I think here that's an actionable strategy. If you got a couple of minutes.
Yeah, I've got a couple minutes. I have exactly. Well, I told myself I'm not doing over-hour shows, so you got exactly 37 minutes of prime time.
If I take 10 minutes, I haven't done my job.
No, you do what you got to do. So I have your yield chart up here, so we can start there.
Wonderful. Okay, so if you look at that, that's a graphic representation of where yields were this afternoon here in the U.S. And it's an inverted yield curve, right? You see that the short-term rates on the left-hand side are the highest yields available. And in fact, those yields are written on the right column. The 1-month T-bill this morning was yielding a 5.53, the 1 month. And stay with that 1 month. We're going to come back to that.
And for viewers to know, that's annualized. Just so y'all know, that doesn't mean 1 month you're making 5.53%. That's over the course of a year. So take that 5.53, divide it by 12. That's what your rate of return would be for the month.
Good point. And I want to say, as a broad generalization, whenever a bond guy talks yields, they always annualize it. It's like your CDs. You buy a 3-month CD, they show you the annual percentage rate. Right. So whenever anybody's talking bond yields or CD yields, they always annualize them. But great point. So yeah, for 1 month, you'd be earning 1/12 of that. Good point. But as you can see, based on just the short end of the maturities, looking at all of the different T-bills from 1 month to 1 year, the 1 month is the highest yielding instrument. So, and a strategy to help you take advantage of this is, some of your audience, and we've talked about these for years, are familiar with bond ladders, where you create a sequence of different maturities. So here's what I'm proposing. If you're looking for liquidity, if you're looking for safety, and if you're looking for income, I think I've got a strategy for you. And it's a very simple Treasury 1 month T-bill ladder. In other words, what you would do under this strategy is looking for safety, liquidity, and income. Those are the three drivers. You're going to take your money committed to that sector of the market, income, safety, liquidity. And you're going to take that pool of money and you're going to divide it into quarters. And the first week, you're going to buy the 1 month T-bill with 1/4 of your money. Monday morning, you'll buy the 1 month T-bill on the auction. I'll come back to how you do that and the benefits, but you're buying the 1 month yield. That's the point. Now, the following week, you're going to take another 1/4 of your money and buy that week's 1 month T-bill. And you'll do that consecutively for the next 4 weeks. So over the next month, you will invest your liquid, safe money in 4 different T-bills. And those will start maturing on week 5, right? Your first T-bill you bought on the first week will now mature by the 5th week.
Right.
It took you 4 weeks to spend all your money. So the point is, by the time you get to week 5, you're going to have a stream of 1 month T-bills coming due every week, I'm sorry.
Right. Every week.
And that gives you liquidity, right? If you need money, you've got cash coming into your account every week. And if you need that cash, by all means, go spend it. But if you don't, what you do is reinvest that money back into another 1 month T-bill. Now, with the Fed holding the Fed funds rate, where they're holding it for the last month and a half, this 1 month T-bill at auction has yielded 5.40 or 5.41 every Monday morning for the last month. In other words, that yield is kind of locked in as long as the Fed keeps the Fed funds rate where it is. So the inverted yield curve now becomes your friend. You're going to be locking in the highest rate in the market. You're also going to keep a steady stream of income, of maturities coming due every week to reinvest or meet your cash needs. And we're talking about a government-backed portfolio. So this is exempt from state and local income tax. And you can do this entire process off a website called treasurydirect.gov. This is where you and I and the retail individual, and we talk treasurydirect.gov for a lot of things, but this is where you can buy your 1 month T-bills. And the beauty of this program is there's no charge, right? You're going to construct this portfolio and there's absolutely no charge. By buying the treasuries at treasurydirect.gov on the auction every Monday, you get the same yield as the institutional market, and you can do it in $100 denominations.
Yeah, I'm looking at your benefits here, and it's like it's hard to beat this. And again, before we get, let's go off camera here, but like for most people here, right. At this point, your head might be going, what the hell is he talking about? I don't get. I just want to put money in an account and just let it make money for me, right? That's what most people are thinking about, but. Right. It's not as complex as it sounds. So basically what you're doing is you're taking, let's say you have $1,000 per month that you could spend. You have $1,000 and you say, okay, on that first week, I'm buying $250 worth of these short-term treasuries. The next week, you do it again. The next week, and these are 1 month treasuries. So you keep doing that for 4 weeks straight. At the end of 4 weeks, you've done $250 investments 4 times. All $1,000 of your capital is now committed to these 1 month treasuries. At the end of that 1 month period, the bond will expire, the treasury will expire, you get your capital back plus interest, and then you literally you could automatically, not hit a button, but automatically have it continue by the next month, the next month, and next month. And that will just keep on going until you turn that system off. If you did it manually, pain in the butt, a lot of logistics, got to do a lot with it. But since you can automate it, and I'll have Bill explain that here in just a second, you've circumvented the biggest challenge which most of us have, which is, what's the mechanics of this? How do I do that? Yes, I can see the benefits on the screen here, which are I'm getting the highest yield in the market, shortest maturity. They're government backed. I've got no fees. I've got great liquidity and flexibility. And I think the beautiful part about this is, as Bill mentioned, if you need your money, you could buy a one year CD. Now you're locked in for a year. With this strategy, most likely you're going to beat just about any CD that's out there and have your liquidity every week on those bonds maturing. So to me, it's really, really interesting strategy that most people don't do. Now, talk to me about the automation of it, because when we look at something like this, most people don't want to take the time. They want to buy a CD and give me my 4% for the next year. I don't care. How do I make this as easy as possible?
And I don't deny that. And for people, maybe there is. But if you were willing to spend a few minutes, the website that we use a lot is called treasurydirect.gov. And what you would actually do is you would apply and open up an account with the Treasury Department. You're going to be buying new issue treasuries directly from the Treasury at those weekly Monday auctions. Now, I'm not going to lie to you. The website itself, I wish, was a little bit user-friendly when you actually set up the application. I'm not going to lie. But once you have it set up, because as you mentioned, and this is the important feature, you can have it set up for automatic reinvestment. You don't have to do anything. Normally 1 week before your T-bill matures, you would get an email from Treasury Direct saying, what do you want us to do with the money? Do you want us to send it to your bank? Do you want to reinvest it? Do you want to whatever? You're going to pre-set up this for an automatic reinvestment feature. So you don't have to do anything. And that's really the beauty of it. And the government offers all these services, including holding onto your treasuries for free.
Yeah.
Why pay a money manager something that you get for free? I don't understand.
Oh, it's just lack of people just to know. Liz, you got me. Liz caught me. You're right. Bill did say this. She said, Didn't Bill say $100 increments, in which case you couldn't buy 254? You're correct. My brain just automatically went to $1,000 for the month, but you're right. You wouldn't be able to do that. So you'd have to do a 200, a 200, a 300, a 300, call. But you're right. It has to be $100 increments. So good job, Liz. She's paid attention.
Yep. Good call, Liz. Yes. But $100, but I would point out that's a benefit of Treasury Direct, because if you were to buy these bonds directly through a broker or dealer, they'll tell you it's $1,000 denominations. It's not. It's available in $100.
Patrick says, how much margin do we need? There's no margin on this, Patrick. You don't get borrowed money from the Treasury. Wouldn't that be nice if you could buy government-backed securities with margin? No, I think that this is for. I brought this point up many times. If you look at the strategic investor that OTA teaches, the main goal of that is saying, how do I set up income streams? How do I set up, sources of money coming in that are low risk and consistent? And this is one of those that's, I think, something that people don't talk about, that for all intents and purposes is very consistent. Now, here's the trick. I'm going to go over here, and, he mentioned you got the, 4.46 or 5.46?
5.46.
Something like that.
No, for the auctions, 5.41. Sorry.
5.41.
5.41 for the auctions.
If you look here, this is the traders anticipating, what the rates are going to be in the future. And right now, it appears that they're expecting a 25 basis point cut at the March meeting. That's March 20th. I personally don't think that's going to happen. I think we're going to hold for a little bit longer here, just because the energy prices are such the outlier in the inflationary metric. So that means that based off this strategy, you could, for all intents and purposes, up until March 20th, unless anything changes, lock in that high rate by using these weekly treasuries, or monthly treasuries. Exactly. I think it's a great strategy. And again, it's automated. So if you go to treasurydirect.gov, which is right here, I don't know where that piece is directly right now, but you could go and do a little bit of research, and you could have this automatically. Once your T-bills expire, they roll right into the next contract, and you don't have to do anything. There you go. Done.
And if I could reinforce, if it helps, on January 19th, I've got my next XLT session with the audience, and we're going to be focusing on that. So I had committed I'll draw up the Treasury Direct. We'll kind of walk people through it. But I also want to start talking about kind of short-term and cash alternatives, because there is going to be a time when the Fed starts cutting. Yep. And that's the point at which you want to start extending your maturities. So we should start having that discussion now. Okay, if the Fed is going to say we're no longer going to be where we are and we're dropping it, well, then the individual decision you might have, and I'm going to have this too, is, okay, I got to start looking at longer term investments. Let me lock in today's yield for a longer period of time. Right. It'd be premature to do that now because we don't know if the Fed's going to be cutting. But once they start, then you've got that flexibility. You can move the maturities out.
Yeah, and that goes back to the traditional bond ladder structure, and again, exactly. we're dealing with a very unique situation. That yield curve, which I've pointed out here many times in this program, let's bring up that yield curve differential again, just to know how long we have been inverted on that 10. This is the 10 and the 1. Here's the 10 and the 2, which is more the industry normal term. We have been inverted since July of 2022. You're looking at a year and a half inversion. That is very odd. I mean, who knows what the macroeconomic impact is for our economy? I don't. I've never seen it this inverted and this for this long. It's crazy.
Unprecedented. That's the whole point. It's unprecedented. Nobody does. We are literally in uncharted territory here with the amount of hikes we've done, and now. And by the way, I want to point out, you mentioned something that I would like people to remember: tapering. Yeah. Boy, there's a word that doesn't get a lot of press these days. I mean, you hit it. The Fed has destroyed $1 trillion in cash this year. They're doing $100 billion a month. Doesn't seem to be getting a lot of publicity. It really
does. And bravo. I mean, it's good that they're doing that, but doesn't this? I try to figure out how all these pieces function together. And if the Fed is unloading $1 trillion worth of assets, that means they're selling these assets. More selling of bond products typically means that yields are going to go higher. Right? Because you're more supply, you have to entice more people to buy them. And the only offsetting piece I could think of is that more people are now buying these long-term maturities because they think rates are going to get cut. Man, I'll be lucky if I get that 4.5% 10-year.
And, if you look at something like the TLT, rates have come down substantially in the last month. No denying that. Yeah. They're up 10, 12% on the TLT as of yesterday in just the last month. So, after a huge drop in bond prices over the last 2 years, let's be honest, this drop in yield has given these portfolios a nice bounce back this month.
20%. TLT is up 20% since the end of October.
Wonder. Okay. Wow. I mean, that's almost makes up for the whole 31% of last year, right? TLT
Yeah.
was down
You
31%
know,
last year.
I've got the
All
chart
year.
up here. I mean, while it sounds nice in theory, I would say no. Because if you look back to the peak of 2020, we are down 54% on the
Yeah,
price of TLT. That is,
exactly.
and
You got to put the 3 years together.
you do.
You're
And,
right.
and I'm always like sarcastic. I'm like, but guys, bonds are safe. Bonds are safe. 54% slide in your account if you held TLT. Yeah, I'll safe for you now, buddy. Ouch. Ouch, ouch,
I'm
ouch.
going to rephrase that. Bonds are safe if you let them mature.
Mature, correct. And
So
you're comfortable with that
TLT
rate.
exactly.
Yeah.
PLT has no maturity. If you let bonds mature, they're safe.
Here's a couple questions from Rob L. These are from the very beginning, Rob, so I want to make sure we got to those.
Yeah.
I apologize for them being late, but Rob, first one says, is it time to buy bonds and forget CDs and money market funds?
Well, again, I don't think it's time to get money market funds because right now, as we were just stressing, it's the highest yield in the market.
Right.
So in the yield curve. So I think that question came in before we had our discussion.
Right.
So if you want yield, you want liquidity, you want money market funds. I also kind of said in the beginning, I firmly believe that this price movement of prices going up 20% in a month on TLT, yields going down, has been way overdone. I can't justify the 10-year Treasury under 4%. I really can't. I think those yields are going higher. So I think there will be the time to buy bonds as we approach March and the Fed signals, are they really sincere? Yeah, I think there is value in the bond market now, but I still see value in the short end. And, even if when I say short end, it doesn't have to be money market funds, but, you've got 2-year investment grade corporate bonds yielding over 6% now. 3 years at 6.5%. Those are some yields that people might want to start thinking about, testing.
Yeah, especially if you know what rate of return you need to meet your financial objectives. I mean, that's great.
Exactly.
We lock it in. Go with sound companies, though.
Yeah, I'm sorry. What's that? I'm sorry.
I said go with sound companies, though. Don't go with the...
Yes. Oh, yeah. We're not here to be the junk market.
Yeah.
I also have to point out that CD rates right now are horrible because the banks are awash with cash, right? And there's not a lot of mortgage activity. So the banks don't need your money because they have nothing to do with it. They're already sitting with lots of money at the Fed. So as a result, as an asset class, bank CDs right now are horrible relative to other alternatives. Now you might find a bank that has a blue light special. They need money for 30 days, something. But as a generalization, bank rates right now are horrible relative to others.
There you go. Let's see. What else was there? Rob says, when Treasury Direct rolls over your treasuries, is there a period of days for settlement, or does it just immediately go right into the next contract if you automate it?
Goes immediately into the next Treasury, not contract.
Right.
But yes, it automatically rolls.
The trader in
Yeah,
you.
no, he's a future. Exactly. The trader in you came out. I saw it. So no, if you have a Treasury, it'll mature on Thursday. There was an auction that took place Monday to replace it. And that auction also settles on Thursday. So both your settlement of the old Treasury and your new purchase mature, happen on the same day. They're Thursday of that week.
Nice. So if you got some cash out there, you could go and automate this through treasurydirect.gov. Pretty nice resource for you to kind of capitalize on these very high short-term yields we have. Granted, I do think you're going to see that change over the next couple of years. Certainly over the next couple of years, it's going to change, and you'll see these numbers drop. But for right now, some good pickings, some good short-term rates. And I know we've got a bunch of people in here that are buying the 3-month and just rolling those every 3 months. Similar, it's a bit more active, obviously, doing once a week. It's a little bit different strategy.
And you're giving up yield. You're giving up yield to buy the 3-month over the 1 month.
Correct.
So I was, my goal was to maximize yield and liquidity. So that's why I stayed with 1 month. That's not to say 3 months is wrong. Don't get me wrong. It's just what's your motivation.
Right.
But for yield and liquidity, I'd keep it even shorter than 3 right now.
Yeah. And it's funny, Bill, because most people are going to go and buy a CD. And this is better than the CD.
That's state and local exempt. I keep stressing that.
Yeah. Hard to beat that.
Here.
State and local.
Yep.
That's good.
Yes.
Tell me about your upcoming schedule. I know you got some XLT stuff going on. I know you've got your focus class going on, which I talked highly of that at my presentation the other night. Like, if people don't understand how the bond markets work, you're missing out a big portion of this overall market dynamic. So what's your schedule look like?
Thank you. Yes, we've got the next one is coming up early in January. So January 4th, we've got the next canary in the coal mine where we talk about, the interrelationship between bonds and other asset categories. We try and demystify bonds. It's kind of bonds 101, but more importantly, how it affects other asset categories. Even if you never trade a bond, you really need to know how bonds affect or interest rates affect FX, equities, you name it, almost every asset category. So yeah, so January 4th. But what I'm enjoying is we're now 3 months into this. We do the bond class, the focus class, every week we do an application session. So I get together with the same class every Thursday and we do follow-ups. And it was really in preparation for this that I rolled this T-bill strategy out to them earlier last week. So it's this chance if things come into the market, you don't understand what the Fed's doing, we get together every Thursday afternoon for these follow-up sessions, and I found them very informative. So it's a weekly commitment after that I'm enjoying. But that class is in January, the focus class, January 4th. And then the XLT, where I promised last month, because we had a lot of questions and I just couldn't get to them all. So I said we'd go into treasurydirect.gov and let's get into this a little bit more specifically as to how you can do this, but also talk about other cash alternatives. So that's going to be on January 19th. That's a Friday. We'll do that XLT session if people want to follow up on that.
Sounds good. And he's got his 3-book series that we've talked about that one in the past. If you go to aftraining.co, which is this page right here, and you click on the little shop portion, you'll have those that book set, and it should open up. There you go. You have that 3-book set.
I have to say, Eva's my video producer for a lot of my institutional classes and so on. She's been saying all month is give the gift of financial education. I'm so sick of talking about these books. At the end of this year, this offer disappears. But they're very good introductory books, as you know.
Yep, absolutely. Yep, I got to set myself. So as we wrap up here, and normally I would already start wrapping up, but I'm going to ask you this one just because I think it's interesting, and a lot of people here want to know more about it. That is central bank digital currencies. And we're hearing more and more and more of this. Everyone has their opinion on what it is. My viewers know my stance, my take, and if you don't, you can always ask me, and I'm more than happy to talk about it. So let me get your take on, first off, I'm going to do like 3 questions. Number 1 is, what are your thoughts on central bank digital currency? Number 2, do you think it's going to happen? If not, and when? And then give me a pro and con from your perspective.
Great. It's going to happen, first off.
Well, that was easy.
Because understand, I'm adamant about that, because the banking industry and the financial service industry has really embraced distributed ledger technology. The technology that supports all this, DLT, is greatly embraced. I mean, repo is all being cleared through distributed ledgers. We're now doing a huge amount. I just did a reposting on LinkedIn. Barclays and JP Morgan have set up their own digital currency to do transactions back and forth. So the finance and the banking industry have really embraced crypto. Whether you like the coins or not, that's a whole separate discussion. I'm talking about distributed ledger technology that supports it. So they embrace that. They love it. They've been using DTC, processes most of their trades through distributed ledger now. So the technology's there and it's being used, not necessarily from the banking side. So from that point of view, they're ready for it. They'll be there to embrace it. There are political ramifications, let's be honest. It does provide for greater government oversight, that the government can see everything. And whether that's their motivation or not, it's certainly a ramification of it.
Yeah.
So I understand why certain people are nervous about it, but understand, the Biden administration has already proposed, that $10,000 limit that, if you oversee that, the government gets tapped on the shoulder that you did a transaction over 10,000 of moving money.
Yep.
They have proposed already moving that down to $500.
Yeah.
So with or without distributed ledger technology, the government's going to be looking over your shoulder.
Right.
But there's also a certain reality to it. It is operationally more efficient. We've got, you do the classes, we've got 103 countries out there that are proposing it, 3 already using it. Now they're new, but you want the beta to be a small country, a small economy.
Yeah.
So we've got 3 of them out there working. But from an efficiency point of view, from a cost point of view, it makes sense. I mean, paper money should go away.
Yeah, long time ago.
It should die. A long time ago, the penny cost us 2 cents.
2.7.
The nickel cost us a dime. There you go, inflation.
It's even worse. I mean, you think about it, Bill. If I was a business and I was making a product and it cost me $2,720 to make this item, but I sold it to you for a penny, it's just a question of how long are you going to function before you go bankrupt, right? It just
exactly.
It's the bad math according to any teacher.
Yep. And I should also point out, and this I think catches people by surprise, when we talk money in the US economy, the coins and bills that we're talking about only represent 4% of our currency. Please your people should understand 96% of our money is already virtual.
Right.
Already.
Yeah.
Right? Your money's sitting in a checking account. That's virtual. You get paid by an employer, automatic money sits in. Nobody walks around with bags of currency any longer. 96% of the currency in the US right now is digital, is virtual. Now, it hasn't moved on to the digital distributed ledger platform. It's already digital money.
Right. Yeah. It's kind of scary when you think about all the costs associated with it. I was looking into this as I was building a presentation, and it cost them over $1 billion a year just to make money. Just to make it, the manufacturing, storage. I don't even know if that includes all the distribution aspects of it. Crazy. And at a certain point, all that could be saved annually. Not only that, but just the pure loss of revenue by, making a penny for 2.7 cents and marking it as a penny. Insane to do so. But if we get away with all that, on one hand, awesome, right? It's cleaner. I don't have to touch anybody's dirty ass money, which we know is horrible. The reports about what trace elements are on most money, especially $100 bills, is shocking. I'll let you look at that one on your own time so I don't clog up my browser. But also the ease to move money around, the lack of a need to go to a bank. Everything will just be purely digital at that point. And I think while on one hand it's great, the other side is, as you mentioned, it's Big Brother. They'll be watching every single thing that you do. And for me, I don't care. I have nothing in my life going on that's illegal. Maybe in my teenage days, a little bit of something here and there, but I'm way past that now. I'm not worried about it, but I could see people who are libertarian going, forget this, I don't want it, get rid of it.
I understand the concern, but the reality is it's coming.
Yeah. Do you think there's any way around it? I mean, at this point...
No, well, actually, that's a good question. And I think the actual obstacle here, and you touched on, is going to be the banks. I mean, realize the banks are going to fight this horribly. They've already started. When President Biden signed that initiative this year, talking about exploring the digital option, unlike what some have said, he didn't say we're doing it. He just said we need to explore it.
Right.
But when that was signed, the banks were quick to say, this is not good. I mean, because you said this circumvents the banks. They're not going to be happy about this. A consumer bank could literally be run out of business if we go to central bank digital currency. So I think we've got the banking industry is going to be doing the lobbying against this for anybody who's concerned.
Well, I'm glad you brought that up, because there's actually multiple structures. And the first structure is the one that you were referencing right there, which people are going, hell no, which is the central bank is now controlling everything. Right. That's not the way it's going to ultimately be. They will control the ledger, but people like you and me would not be dealing directly with the Fed, right? That they've already made that clear. We don't want to be mano a mano with the customer. Right. We're still going to be the intermediary for the banks. So the banks will be their role will still be there. We will still interact with the banks, but the banks are the only ones that communicate with the Fed and that ledger. So that's what the structure will most likely be. The other interesting piece here is, which technology are they going to use? Right? There's so much talk about, are they going to use Ripple? Are they going to use some other blockchain out there? My guess is it will be their own proprietary controlled entity. They'll own it all, as opposed to outsourcing to a third party, which would be what's called a synthetic CBDC or an SCBDC. That's what people are talking about when you hear that, is using someone else's technology. So I think we'll have the Fed work with some firm, create their own proprietary technology. We will have nothing but digital money. I say a decade out. By 2033, I think we will not have the conversation of exchanging physical dollars or change ever again, unless it's black market.
I agree with you. I heard you mention a number earlier of 3 years, and that made me skittish. No, I'm with you. Closer to a decade.
I think 3 years for the implementation of the CBDC. And it doesn't mean, because they're not going to implement it right away and then kill cash instantly, right? There's going to be how's this work? Absolutely. What are the kinks in the system? How do we fix that out? And then, there'll be a slow transition, because there'll be people, I'm sure many of you, how many of you here are going to be mad as hell? Type in the chat, I'm curious, and be like, hell no, you're not taking my money away. I'm going to continue to use it, right? We will fight that most likely. But at a certain point, they'll slowly phase it out. They'll make you see how easy it is to use their system. Why would you even want to hold cash? Oh, okay, there you go. Done. And we move on from it.
To give your listeners a clue, though, there'll be progressive steps here. So, for example, the SWIFT system, remember how banks move money around, is the most archaic, antiquated thing. You ever want to get frustrated, go to a bank and try to wire money.
Oh, God, it's horrible.
Oh, it's horrible. When Zelle will do it for you instantaneously, the bank takes you 20 minutes and $35.
Right.
So the first thing you're going to see as the banking industry moves into this transition is SWIFT going on to distributed ledger to improve that. That's a fiasco there. So, they've got some product opportunities here on the banking side. They could present this as some upgraded services. I'm pleased to see that you feel the model is keeping them as the intermediary, because they could design nice products around this.
Yeah, and when you look at and I'm glad you mentioned Swift. Swift is, you just have to laugh about it. It literally is a messaging service, and it's slow, it's antiquated, it is an inefficient process. Transactions get lost. It is horrible. I mean, really, it's like saying, I ask you, what kind of car do you drive? And you're like, oh, I've got a two-stroke pull start, four-wheel vehicle that runs with bicycle tires. Like, what? How do you even get around? You go on the freeway, you're going to die in that thing. So there's an ISO 222. It's 20022, which is this electronic standard for payment networks now. And a lot of these crypto projects are now filing, registering, and becoming ISO 20022 compliant, which now means that they could be part of that global payment network system in that new era. So they are in the process right now of updating our financial system through different compliance protocols. And it's interesting is some of these digital assets like Ripple have been petitioning and getting approval. So now they can make those cross-border payments. Again, it's all going to be tracked. It's all going to be monitored. But at least there's a standardized protocol for it that all these digital asset firms will have to comply by.
Yeah. And I misspoke. I think I said earlier that Goldman and BlackRock had done their own digital system. It was Barclays and BlackRock. My apologies. But the point is, there's distributed ledgers being used throughout the banking industry now.
Yep, absolutely. Wade says, I think you'll be surprised by how bad this will be if ever adopted. Well, again, I think there's pros and cons to it. I personally don't really want it, but you look at the cost to make money, all the issues that come along with it. Big Brother is a scary thing to think that they can monitor every single thing that you do. You think that Apple has a lot of information on you. Imagine if the Federal Reserve or the Fed and now had access to every single thing you bought.
And that is the reality of this. We have to admit that.
Yeah, definitely.
Yep.
All right, Bill, so you got a class on the 4th, you got a class on the 19th, and other than that, you're going to go and do something fun for the holidays, rejoice in festivities, I presume?
Yes, we're going to, the training industry kind of quiets up at year end. So my schedule gets much freer, and we've got some family issues where everyone's happy this time of year. So it's going to be a great holiday this year. Thank you.
Good.
A lot going on.
Yeah, good. Well, I'm glad. I'm glad it's a happy, rejoiceful holiday season for you. I appreciate you coming on this program and all that you do education-wise, not just for my viewers, but also all the people that you train. I'm sure you're a beacon of hope and enlightenment throughout the year. So I appreciate all that you've done, and I hope you and your family have a fantastic holiday. I will talk to you in the new year, my friend.
The same to you and your entire audience. Have a great holiday. Great working you this year, Merlin. Look forward to next.
Always a pleasure. Take care.
Be well, all. All right. Be well, folks. Have a good holiday.
You too.
Thank you.
Guys, that was Bill Addiss. You can find out more information by going to his website, which I will bring up here momentarily for you. Let me kick that off and take my earbuds out. The reprieve of hearing. If you go to, I thought I had it up here. There it is. It's aftraining.co.uk. He's got a bunch of videos there, and he's got all kinds of information about upcoming courses he's teaching for on the Training Academy, etc. So a lot of great information there. Check that one out. All right, let me real quick, since I didn't want to do an hour show, I will run through some final numbers here real quick. I'm going to do this in under 5 minutes, so I apologize if I'm going to rush through this. But interesting day. You had Bitcoin. I'll zoom in here just so you can see the chart. It's staying within that little triangle we drew out the other day. It's kind of just channeling sideways. It was down 0.79% today. No big deal. Dollar index down 0.08%. Right, just slightly down after that nice bounce back to the upside yesterday. Again, not that big of a deal. If it does rebound here, it most likely is going to stall out somewhere within this downtrend that's been intact since early October. The 10-year, we saw that yield today relatively unchanged. You can see our Monday session, we opened at 3.93%. We closed at 3.931 or 3.935. So ever so slightly to the upside of 0.56% today for that 10-year. So no big deal there. Again, expect a quiet week. Here is the Russell, which had this shooting star formation today up in that overhead supply level, closing at 2005. It was just barely up. Gold. Oh, I saw gold move up today. Again, I did not sell calls against my silver. I'm thinking about doing that tomorrow, but I think silver's going to have a little bit of a rally here, so I may hold off on selling calls against the position I have. But gold is up 0.25%, closing at 2,040. And then the indexes start to take hold. S&P 500, not quite at all-time highs today. We got pretty close. NASDAQ as well. I saw someone say that NASDAQ hit an all-time high. It did not. It did not. I'll show you the numbers here in just a second. S&P was up 0.52% to 4793. Second place was the NASDAQ, up 0.71% to 16,939. Does it stop? Does the NASDAQ ever stop? Finally, crude oil, which we talked about earlier, was up 1.45% on the day, making your best performer. Now, let me go show you the NDX here real quick, just so we can look at the indexes. I know people were asking, did the NASDAQ break an all-time high today? That red line at the top is your all-time high, and that goes back to the peak that was back right around late November of 2021. That high is 16,764. Today, the high was 16,764.32. Well, the all-time high was 0.5, let's see, it's 0.54 above us. So 1/2 of a point. So yeah, for all intents and purposes, we did, but we didn't technically close above it or break it today. Most likely that's going to happen tomorrow. We'll rejoice at the NASDAQ hitting all-time highs again because the momentum is just hard to beat. If we look at the SPX, and I go out here and look at that peak that goes back into same period of time, December of 2021, that high is 48.18, and currently we are sitting right now at a price of 47.40. So I got a much greater distance to go to get to the all-time highs on the S&P, but NASDAQ ripping through it, and no surprise because it has been the absolute truck moving higher and higher and higher. Yes, Patrick, remember, if you're looking at the futures represent a price in the future, so they're already anticipating it's going to break, which is even stronger reasoning why it should break to the upside. So yes, the futures markets may be at all-time highs, but the actual index itself has not, right? Futures are forecasting price next month or the next month or the next month. That means that the expectations are we're going to be higher. So there you go. All right, that's going to do it for me. What time is it? Oh, yes, I made it out here in under an hour. That was my goal. I'm going to see if I can get Jerry Baldwin on either tomorrow or the next day and get you one more guest on the program for today. Yeah, the whole shirt, the Run DMC, there you go. One of my favorites. I grew up with the Beastie Boys License to Ill album on one side of the cassette, and I think it's called Louder Than Hell by Run DMC on the other side, and I wore that tape out. Loved it. I absolutely loved the pioneers, the OGs. Not this garbage I hear today with voice changers and all kinds of crap. To me, that was old school, real hip-hop was the good stuff. Anyway, my music preferences don't matter to you. That's going to do it for today's show. If you guys have comments, questions, feedback, things you want me to talk about, email it, TraderMerlin@gmail.com, or put them down below any of the YouTube videos. I didn't check the comments today. I apologize. I was so busy, but I will get to those comments tomorrow and make that the show. And again, I'll try to get Jerry on either tomorrow or Thursday. So thank you guys so much. Have a fantastic remainder of your day. Again, check out Bill Addis's page there. He's got some great content at aftraining.co. Be careful, my friends, on tomorrow's session. It's going to be low volume. We'll see you tomorrow. Take care.